Every business on earth lives and dies by one thing: cash flow. Solve it and you solve everything else. So that might seem overly simplistic, but that's true. If you can solve cash flow for each of your clients, you'll have no problem getting and keeping CFO advisory clients. When you think about it, every business that failed did so because they weren't able to generate positive cash flow on a regular basis. Even if they don't turn a profit, as long as they have positive cash flow coming in, the business will continue to exist. Like so many tech startups, it can take years for some businesses to become profitable, but they still have positive cash flow coming in the form of investors that allows them to stay in business. Most small businesses don't have this luxury, so they need someone in their corner that can guide them to solve the cash flow problem for them. So, how do you do it? Let's start by breaking down what exactly is cash flow. Cash flow is simply a measurement of the amount of cash a business generates after all of its monthly obligations have been paid. Things like expenses, debt servicing, etc. A business has $10,000 in the bank at the end of the month and $10,001 in the bank at the end of this month. Then the business has a positive cash flow of $1. Doing this month after month means the business has a consistent positive cash flow. And if you can help a business have a consistent positive cash flow, then you can solve all of their other problems. You've already solved the main one. The reason consistent positive cash flow is so important is that this leftover money is money that the business owner can use to do basically whatever they want with. They can pay themselves or their employees more, reinvest it back into their business, pay down debt, expand, buy more equipment, really anything. And cash flow is measurable. They can measure how much it increases or decreases over time. It's the simplest, most direct way to measure both the health of a business and your impact on the business's performance. Now that we understand why cash flow is so important, we need to understand all the factors that contribute to cash flow. We call these drivers because they drive or influence cash flow. And every business everywhere has pretty much the same drivers. And while the drivers may vary in importance depending on the business, they are all still contribute to a business's cash flow. The main drivers of cash flow of almost all businesses are revenue and profit. These two drivers are pretty much self-explanatory. Days sales outstanding and days inventory outstanding. These drivers tracks the number of days it takes for clients to get paid by their customers and the number of days it takes your client to sell through their inventory. Your clients ideally should have both a low days sales outstanding and days inventory outstanding. The next driver is the sale or purchase of assets. Think of a construction company buying a new truck. Purchasing an asset decreases cash flow. Selling one increases it. The next driver is days payable outstanding. This measures how long it takes your client to pay their suppliers. Usually your client would like this to be higher, so they can hang on to their cash longer. The next driver of cash flow is using or paying down debt. As I talked about before, your clients probably don't have investors, so many businesses must take on debt. So when your client uses a debt, this increases cash flow, and paying down the debt reduces cash flow. This can be a tricky one for your clients and usually requires a good balance and careful planning. The last driver is owner investments or distributions. This is just a measurement of any cash your client puts into or takes out of their business. Your client might want to invest in their business in order to avoid gaining debt, so they can purchase, for example, a new truck. Later, once they use that truck to run some new jobs and get a positive ROI, the owner can take a distribution from the business and pay it back to themselves. The investment contributes to positive cash flow and the distribution of negative flow. When you take all the drivers I just mentioned and combine them with the drivers of profit and the drivers of revenue, you can determine which drivers are performing well, which ones are underperforming, and what drivers have the greatest impact for your client's business. And then you create a plan for your clients to do the one thing needed to stay in business. Guide them on generating positive cash flow on a regular basis. And once you solve it the first time, you keep solving it again and again. This is how you help your clients get the one thing they really want: a growing, successful business. And this is how you become irreplaceable. Thanks for watching this video. The team here at the CFO Project has put together some free resources just for accountants, bookkeepers, and tax professionals who are interested in providing a CFO advisory service. Click the link below or go to thecfoproject.com/YouTube.